When we study success, we almost always look at the highlight reel, the huge record-breaking wins. But honestly, sometimes the most powerful lessons are hiding in plain sight in a year that looks, well, completely unremarkable. And that's exactly what we're doing today. We are cracking open Berkshire Hathaway's 2004 annual report. It's a year that, on paper, looked like a bit of a failure, but is actually a total masterclass in the principles that built an empire. So it all starts with this number right here, the one that got all the attention. In 2004, Berkshire's book value went up by 10.5%. Okay, solid, but not exactly spectacular, right? Well, here's the problem. The S&P 500, the benchmark they live to beat, was actually up 10.9%. So for the first time in a long, long time, the legends of Omaha had officially lagged the market. And this wasn't something they tried to hide. No way. Warren Buffett opened his letter to shareholders with this incredibly blunt admission. He made it clear that the dozens of businesses Berkshire owned had a fantastic year. The failure, he said, was his, specifically in his most important job, putting the company's money to work. And here's exactly why he felt that way. This was Berkshire's cash pile at the end of the year. $43 billion, just sitting there in low-yield assets, basically doing nothing. Buffett was frustrated. He had this mountain of capital, but couldn't find a single big company or stock that was priced attractively enough to buy. As he put it, he just couldn't find a good pitch to swing at. But this, right here, is where the real genius of the whole operation kicks in. So how is it possible? How can a company fail to find investments, underperform the market, and still be one of the greatest wealth creation machines in history? Well, the answer is in this engine that's always humming quietly beneath the surface. Back in 2004, that engine was a $46 billion phenomenon called insurance float, and it's the absolute key to understanding how they can afford to be so incredibly patient. So what is this secret sauce, this float? Put simply, it's the money that customers pay in premiums that insurance company gets to hold on to, sometimes for decades, before any claims are eventually paid out. It's basically your money sitting in their bank account. And this analogy is just perfect. I want you to imagine someone gave you a massive multi-billion-dollar loan that you never had to pay a single cent of interest on. I mean, that's already powerful enough. But what if it was even better? What if, instead of you paying them interest, they actually paid you for the privilege of holding their money? Well, that's the Berkshire Hathaway model. They take this giant pool of cash and invest it for their own benefit. The way it works is just beautifully simple. An insurance policy gets sold, and the premium is collected immediately. Berkshire then takes that cash and invests it in stocks, bonds, sometimes whole companies. And then, way, way down the road, we're talking maybe 50 years later, a claim comes due and it gets paid. That massive time gap, that's where all the magic happens. Okay, now here is the crucial point. This is what separates Berkshire from pretty much everyone else. For most insurance companies, this float actually comes at a cost. They'll often price their policies so competitively that they lose money on the insurance itself. That's called an underwriting loss. But Berkshire is so incredibly disciplined in what policies it writes that it consistently aims for an underwriting profit. This means they are literally being paid to hold and invest that $46 billion. Their loan isn't just interest-free, it's better than free. And achieving that better than free float, that is no accident. It requires this specific iron-willed discipline that runs completely counter to how most businesses think. And there is no better example of this philosophy in action than one of their own insurance subsidiaries, a company called National Indemnity. Just look at these numbers for a second. From 1986 all the way through 1999, the revenue, the premiums they wrote at this company didn't just slow down, it completely cratered by over 85%. And this wasn't because of a bad economy or a lack of demand. Nope. It was a conscious choice. They just flat out refused to write policies at prices they believed were irrational and unprofitable. I mean, seriously, think about the courage that takes. We live in a world where Wall Street is obsessed with quarterly growth. It punishes any sign of stagnation. And this company chose to shrink for over a decade. Any normal CEO would be fired for even proposing a plan like that. The pressure to chase revenue at any cost is just immense. But Berkshire's entire culture is built on rejecting that pressure. Buffett uses this simple baseball analogy, and it's absolutely perfect. The goal isn't to swing at every single opportunity that comes your way. The goal is to wait patiently for the one you know you can knock out of the park. This discipline, whether we're talking about underwriting an insurance policy or buying a stock, is the absolute foundation of their success. And it's the exact same logic that led them to sit on $43 billion in cash back in 2004. They were just waiting for a good pitch. And this right here, this is where the lesson pivots from Berkshire's strategy to ours. See, Buffett argues that this exact same patience is the key to success for individual investors like you and me. He says the greatest risk to your financial future isn't a market crash or a bad economy, it's your own behavior. So, in the 2004 letter, he calls out the three great destroyers of wealth. First, high costs. That's from constantly trading in and out of stocks, which just racks up fees and taxes that eat away at your returns. Second, chasing fads. Jumping into an investment not because you understand it, but because everyone else is talking about it. And third, trying to time the market, getting swept up in the euphoria at the top and then panic selling at the bottom. This one line sums it all up so beautifully. The two things that drive the entire financial media and Wall Street, excitement and activity which generates expenses, are the exact two things that are most dangerous to your wealth. What that tells us is that successful investing is less about being the smartest person in the room and far, far more about having the right temperament. So if you can control your costs and you can avoid chasing trends, what's the one operating principle that lets you master the most powerful force in the market, the psychology of the crowd? How do you turn the emotions of other people from a threat into an opportunity? And there it is. You could argue this is the most important piece of investment advice ever given, and it's laid out right there in this very letter. It's the ultimate contrarian mantra. And suddenly that boring 2004 makes perfect sense. Sitting on $43 billion wasn't a failure to act. It was Buffett being fearful while everyone else was being greedy. The insurance float is the financial engine that gives them the firepower to wait. And this rule is the discipline that tells them when to use it. And that's the real lesson from Berkshire's worst year.